Okay, so no change from the Reserve Bank to date. Certainly the market wasn't expecting a cut from the Reserve Bank. The decision by the Reserve Bank in early December to cut by 25 basis points was largely dictated by what happened in late November. We had weak capital expenditure survey data that was released at that time, which showed that the mining investment boom may actually be finishing sooner than what the Reserve Bank initially thought. So based off that weak CapEx data, we expected that the Reserve Bank actually thought that the economy needed further stimulating and decided to cut at that time. Since the December meeting, we've actually seen a rebound in the iron ore price particularly. It's risen from $110 to over $150 at the moment, so 30% appreciation in the iron ore price. So projects that previously were put on the shelf may actually be revisited now given the stronger iron ore price. What we are wary of at the same time here is there's been no rebound in the Chinese steel price. So even though we've seen this iron ore price recovery at the moment, we're not sure if that's the product of additional Chinese demand for steel and an infrastructure spend that actually supports economic growth through China. So whether it's actually a longer term consideration or whether it's just a short term restocking phenomenon, we'll actually have to wait and see. And that'll actually be very key in determining what the Reserve Bank does going forward. If it does determine that the CapEx outlook has increased, then it's likely that the Reserve Bank remains on hold, certainly for a considerable period of 2013. The external environment for Australia, it's certainly improved more recently. The economic growth out of China, data released recently showed that growth had increased from 7.4% to 7.9%. We've had the Japanese government also announce a lot of quantitative easing via the Bank of Japan to stimulate further growth through there. Sentiment out of Europe more recently has improved as well. So we had the ECB President Mario Draghi come out and actually talk about positive contagion through Europe. And we also had some of the banks repay their LTRO funding in late January, which has actually done a lot to improve sentiment out there at the moment. So generally it's a more feel-good story at the moment. Actually think there's a few headwinds still for the Australian economy. Fiscal policy is certainly doing nothing to promote economic growth through Australia, and we've also got the elevated level of the Australian dollar at the moment that's providing headwinds for our manufacturing sector, tourism, education and a few other things. So certainly some headwinds ahead of us. Against that, we've also seen a deterioration or decline in the credit spreads at banks at the moment. So if you had a look at an Australian major bank in the middle of last year, they would have issued 5-year term funding at around 150 points over BBSW. More recently, that's actually contracted to around 90 to 95 basis points. And what that may actually mean is that we start to see banks cut the standard variable mortgage rate despite the Reserve Bank not cutting the cash rate. So it actually reduces the pressure on the Reserve Bank to provide further monetary policy stimulus. We expect that the bank will be on hold for a while until they actually see the evidence emerging of what past monetary policy easing has had, the effect on the Australian economy of that. And they'll wait and see and then see if it needs further stimulation.